As founder and chairman of Portland Holdings, Michael Lee Chin is widely regarded as a visionary entrepreneur whose philosophy, doing well and doing good, has resulted in extraordinary business success and inspiring philanthropic initiatives. Portland Holdings is a privately held investment company that manages public equity and private equity and has an ownership interest in a diversified collection of businesses, operating in various countries and numerous sectors, including financial services, insurance, media, tourism, agriculture, real estate development, and biotechnology. Portland is committed to building strong Indigenous businesses. And equally important, these businesses must seek to improve the social well-being of the communities in which they operate. Michael is firmly committed to creating wealth for investors. As chairman of Mandeville Group of Companies, Michael has assembled a diversified group, including an investment dealer, a registered investment advisor in the US, a life insurance agency, and an investment fund manager, an exempt market dealer, among others. This group of company includes, but is not limited to, Mandeville Private Client Inc., Mandeville Private Client USA, Mandeville Insurance Services, and Portland Investment Council Inc. Among his many personal accomplishments, Michael has received Doctors of Laws degrees from a number of distinguished universities in Canada and Jamaica. In 2008, he was awarded one of Jamaica's highest national honors, the Order of Jamaica, for his significant contributions in business and philanthropy. From 2011 to 2016, Michael held the esteemed position of Chancellor of the Wilfrid Laurier University. In 2016, he was appointed chair of the government of Jamaica's newly established Economic Growth Council in an effort to bolster economic development. In 2018, Michael was appointed to the Order of Ontario, the province's highest honor, reserved for those whose contributions have shaped the province, the country, and beyond. Please help me welcome Mr. Michael Lee Chin.
Thank you, Akila. Good morning, guys.
Good morning.
All right, to kick things off, thank you so much for being here. And I think, as many of you know, when I joined, I was with a previous firm, and I think by the end of this conversation, you will have a very good understanding of why I'm now with Mandeville Private Client. So, Michael, thank you for being here. And many on this call, they know your background. It's a beautiful story. You went from rags to riches. But how did you do that? And could you explain to us a little bit about your early philosophy when you were building your wealth? And what extent today does your asset management business reflect your philosophy?
Well, I started off in 1977. I'm a civil engineer by training. I graduated from McMaster University in 1974, so that dates me. I practiced engineering for 2 years in Jamaica, went back to Jamaica. I was on a scholarship from Jamaica. And then I came back to Canada in 1977. So I couldn't get a job as an engineer. There was a recession for civil engineers in 1976, 77. So I had 3 non-engineering offers. The first was to be a soap salesman for this pyramid scheme. The second was to be a long-haul truck driver. And the third was to sell mutual funds for what is now Investors Group. Then it was Investors Syndicate. So I said, I'll try I'll accept Investors Group's offer. So now at 26, being an immigrant, I knew no one who had money, but I had to be selling mutual funds. And that was my job. So I needed to find people with money. So I had to cold call. So when I cold call and someone would say, okay, Mike, we'll see you. I felt such a debt of gratitude that when I sat at their kitchen table, I'd ask myself the question, what is the highest value I can give to this family here tonight? What is that one thing? And the answer kept coming back to me, make them wealthy. That's the highest value add any advisor can give to the family in which he or she is advising. Make them wealthy. Oh, I'm a scientist. Is there a formula that if you practice consistently, the only outcome is wealth? No different from mixing 2 atoms of hydrogen with 1 atom of oxygen, you get water every time. Is there an equivalent formula? And if there is, I want to find out what that formula is. Because if I did, I'm going to live it, and that I'm going to be an advocate for that methodology. So it took me a year. And I have a process being a scientist. And the process is the following. I observe. I create a hypothesis around my observations. I stress test the hypothesis. If it holds true, I codify. And then I hardwire it so it becomes who I am. So yes, and by the way, remember the question, is there a formula that if you practice consistently, the only outcome is wealth? If you're to Google today that question, nothing will come up. Only a bunch of books by people who are trying to make money on you selling books. But I figured it out in 1978, a year later, going through that process. And here's what I observed. I observed that every single wealthy person in the world who created wealth, not inherited it, or not, or didn't steal it or win it, who created it, did 5 things. Number 1, all of them owned a few, not too many, high quality businesses. Number 2, all of them really understood or understand their business, the industry, etc. The word understand, what you own, is paramount. Number 3, every single wealthy person in the world who created wealth, those entities that they own, those assets, those businesses are domiciled in strong long-term growth industries. Number 4, they all use other people's money prudently. And number 5, their attitude towards ownership is, I'll hold this business for as long as it remains a great business. So that's what I discovered. So I now codified it into what I call the 5 laws of wealth creation. And I lived it. I've lived it. As I said, I codified and hardwired. So I've lived it since 1977. So that is the behaviors that I identified with investors. Now, I also identified the qualities of the business or businesses that they own or owned. So if you can match investor behavior with the qualities of the business of wealth creating businesses, then you have a definitely win of businesses, of wealth creating businesses. And there are 10 of them, maybe more, but I identified 10. The first is wealth creating businesses are invariably owner operated. Secondly, the ownership of these businesses are heavily concentrated in a few, owned by a few people, not too many. So heavy concentration of ownership. Thirdly, there's personal identification between the business and the owner, and the owner and the business. And as I go through these 10 lists of criteria, think Apple under Steve Jobs as an example, or think your local convenience store. Number 4, decision making is not made on a democratic basis by wealth creating companies. They may solicit opinions, but the final decision is not made by a vote. It's made, so the decision making will be more autocratic than democratic. Number 5, wealth creating businesses are entrepreneurial. Number 6, they have low turnover of management. Number 7, one moment, please. Number 7, periodically these businesses make a profit. And when the profit is allocated, whether it's to buy a new plant, another company, or some real estate, when the profit is allocated, if the allocation is a good one, the owner operator or the owner operator's net worth increases. If it's a bad one, the owner-operator's net worth decreases. In fact, the owner-operator could go bankrupt. In other words, it is tantamount to flip a coin, heads you win, tails you lose. The risk-reward for capital allocation is symmetrical. The time horizon for wealth-creating businesses, long-term. The focus of the board of wealth-creating businesses is singular. Growth, growth, growth. Every day, that owner-operator comes into work and says, how do I grow these babies? And lastly, validation of success would be a function of customer satisfaction, sales growth, market share, margins. So those are the 10 characteristics I identified with wealth-creating businesses. Now, only the most successful, and by the way, these are the characteristics of the quintessential private business. Now, only the most successful private business graduates to the public markets. Now, here's what happens the day after graduation of this wealth-creating private business to now being a public company. Whereas before the private business, private wealth-creating business was managed by an owner-operator, in the next day when it became public, after it became public, there's a separation between the owners and the operators. Management are different from shareholders. So there's a separation, and therein is where the problems start. Because the board of directors, to create order, to have order in the business, because of the separation, there has to be a board of directors, a corporate governance structure, starting with the board of directors. Now, who are these board members? Do they have to be fit and proper to become a board member? Do they have to have experience at creating wealth for companies? No, they can be ex-politicians, ex-doctors, ex-lawyers. But one thing they have in common, they're all agents. They're agents of management, agents of shareholders. And who are they supervising? Management. So we now have, and who are these management people? They're also agents. So we have agents overseeing other agents. We now have introduced agency risk squared. That's where the problem starts. Now, secondly, the day after this beautiful private business, wealth-creating business, went public, the ownership wherein it was heavily concentrated is now broadly dispersed. And hence, can you put a face to BCE? Can you put a face to BC? No. The ownership is anonymous. Whereas in wealth-creating businesses, the decisions were made in an autocratic way. In a public company, it's a perfect democracy. Whereas the wealth-creating businesses are entrepreneurial in your public business, because the agents who manage these businesses, their first concentric circle of responsibility is to themselves. Don't lose my job. So what they do, they build bureaucracies. So whereas in the previous life of the company, which was private, it was entrepreneurial, now it becomes bureaucratic. In fact, a friend of mine who owned a large trucking company in Canada, in fact, I live in his house today, he's a billionaire, and he once told me, you know, when I owned this company, we had, my HR department had 9 people. When I sold it to this large Canadian conglomerate, the HR department went up to 189 people. Right? The company eventually went bankrupt. Whereas there's low turnover in your wealth-creating business, in your public company, high turnover. The average tenure of a CEO in a private business is 35 years. In a public company, 3.5 years. Whereas when profits are made and the profits are allocated, if it's a good one, if it's a good capital allocation, management gets a bonus. If it's a bad capital allocation, management gets half the bonus. If it's a really ugly one, management gets a golden parachute. The metaphor is flip a coin, heads management wins, tails management does not lose. So the risk reward is asymmetrical. Whereas in the private wealth creating businesses, the term of the approach was everything was, decision was made based on the long-term perspective. In your public company, the day after this private business became public, the focus is now short-term, quarterly earnings. That's the focus. And there's a totally different decision-making tree. You go down when you're thinking is long-term versus short-term. Whereas in terms of corporate governance, the focus of the private company was singular: growth, growth, growth. The day after, when it became public, the focus is risk and compliance. Minimize risk and maximize compliance. And lastly, the 10th characteristic, whereas the fundamentals for the validation of success in your wealth creating business was a function of customer satisfaction, sales growth, market share, etc. In your public company the day after, its stock price, mark to market. So you can see there is a difference between wealth creating businesses and your typical public company. And the problem is the 10 characteristics of the typical public company are the opposite of how the company created wealth in the first place. So what I did, I identified a framework for investor behavior, the 5 laws, and a framework for seeking out businesses that are wealth creating, whether in the public space or the private space. And that's what as I said, I hardwire it so it becomes who I am, and that's what we do.
All right. So thank you for outlining that. And I know you've been an advocate for democratizing access to private and alternative investments to your own clients. And what prompted this, that you thought it was so important that you had to go back to your clients and let them know what you discovered?
I as an advisor, I would advise clients, but I still have clients. And in 2007, I sold a business that I had built, Berkshire Investment Group, to Manulife. And at the time, Berkshire Investment Group, I grew this business from 0 to 1,000 advisors across 300 offices in Canada. It was the largest financial planning organization in Canada, and I sold it to Manulife in 2007. And I got shares of Manulife back then, and I was the largest private individual shareholder of Manulife in 2007, having sold this business to Manulife. So I thought to myself, well, Manulife, the share price I got was $40 per share. So at 7%, value, money doubles in 10 years. At 7% rate of return, it doubles in 10 years. So this is 2007. So I thought by 2017, that $40 share should be $80. By 7 more years, 2024, $160. By 2020, it should be about $110. That's what I thought. The reality is, the crisis came in 2008, 2009, financial crisis. The stock price went from 40 to 9. Today, 2020, it should be 120. It's 16. So in 2011, I thought to myself, I was doing a post-mortem on the crisis, financial crisis. And I thought, how did I survive this crisis? What did I do? And I thought, I concluded it was my privately owned businesses that got me through the crisis, not my public companies, the proxy being Manulife. If I had held on to Manulife, I would have been toast. So I thought, wow, Mike, but you're an advisor. And like every single other advisor, your clients, their portfolio is comprised of 100% publicly traded securities, whether individual stocks or mutual funds, 100%. Yet still, your bacon was not toasted because you owned not private businesses only, but a combination of private and public. Sorry, not public only, but a combination of public and private. And it's a private that saved your bacon. But your clients that you advised, you're advising, they own only public companies. You're like the typical advisor. So I thought there is a fundamental dysfunctionality here in how advice is given. So I have two choices. I can sail off on my yacht into the horizon and say, well, what do I care? Every advisor in the world, this is what they do. Or I can say, no, everything I have accomplished in my life is a function of the fact that I have clients. So the second choice I have is come back, start a business that give clients the opportunity to build portfolios no different from CPPs, which is a combination of public and private assets, onto your teachers, which is a combination of public and private assets, or the wealthiest people in the world, combination of public and private, which is what I did. Because there's a dysfunctionality in how advice is given, whether you're from TD Bank, RBC, it doesn't matter. Or Goldman Sachs, or a securities dealer in Australia, they're all the same. Clients get 100% public securities, and that is dysfunctional. So it's the realization that there's an endemic dysfunctionality that exists that inspired me, because my attitude has always been, I don't do anything unless I'm stirred by a purpose. I'm purpose driven. So I identified a dysfunctionality, so I'm here to fix it. Simple.
Thank you. And, you know, I know philanthropy is important to many of us on this call, obviously being Rotarians, and you yourself have made several multi-million-dollar donations, and including a $30 million donation to the Royal Ontario Museum. What advice can you give to others who are thinking about giving or wanting to understand what the legacy is involved in that? And why is philanthropy important to you?
Well, all of us, at some point in our life, if we're thinking, we have to ask, why am I doing what I'm doing? Why am I doing this? And what is fulfillment? What does fulfillment mean to me? Just to go to work every day, pay the mortgage, pay the bills, look, raise my kids. Is that fulfillment? Or is there a higher purpose? So I had to go through that assessment personally. And what I concluded was fulfillment means the following to me, and it's personal to everybody else, to everybody. Number one, I have to do well. And at the same time, I can't do well as an island unto myself. I'm standing on the shoulders of many people I don't even know. So not only do I have to do well, I have to make sure I recognize that I'm not an island unto myself. I have to do good for the various concentric circles, starting with my family, then next radiating out from the first concentric circle, my town or my city, my community, my province, my country, the world. So it remains indelibly clear in my mind every day what my purpose is. I codified it in terms of the following: prosperitas cum caritate, prosperity with care. So that's my mantra, prosperity with care. And by the way, it takes, as a prime minister once told me, it takes cash to care. So the first thing one has to do is to have a methodology to create wealth. The second thing is, once you create the wealth, don't be selfish. Those who can should help other people. Prosperitas cum caritate. I went through with you the framework, the 5 laws and the 10 characteristics, that if you practice slavishly those 15 traits, there's no question as to what's going to happen in terms of your ultimate prosperity. But once you're, as I said, prosperitas cum caritate is my tagline: prosperity with care. Do well, do good.
And how did you end up donating to the ROM?
Well, that's an interesting story.
I know.
So you guys are from Toronto. So I'm in Burlington. So in 2002, March of 2002, 2003, remember we had SARS in Toronto, right? Toronto was in a funk. Nobody wanted to do anything in Toronto. And we had President Bush bombing Iraq in 2003. So at the same time, concurrent to that, in that environment, the Royal Interior Museum was doing a fundraise for $200 million. And no one wanted to step up and be the lead donor. So this particular Mrs. Weston, Mrs. Hillary Weston, who was then the Lieutenant Governor of Canada, called my office and said, I'd like to come and see Mr. Leachin. She didn't say why she was coming. So it was a Tuesday, sorry, it was a Tuesday afternoon at 2 p.m., end of March 2003, that the appointment was set for. So that previous night, I came home from work, 11 p.m., and Forbes magazine, the Billionaires edition, comes out in March. And the March edition, that year's edition, was sent to me from New York. It was not yet in Canada, so it was sent up to me. So I'm at 11:30, I'm leafing through this Forbes magazine, and I came to the centerfold. And what did I see? I saw Mrs. Weston and Galen juxtaposed beside myself. So I thought, oh my gosh, I've never met these people. I have a meeting with Mrs. Weston tomorrow morning, and here it is. I'm meeting her for the first time in Forbes magazine. What is this, omen? So I was curious. So the next day at 2 p.m., I went into my boardroom. She was sitting there with Jim Temerty, who just donated $250 million to the U of T, medical school. So the next day, Mr. Temerty and Mrs. Weston were sitting in my boardroom. So I went into the boardroom and I said, okay, so Mrs. Weston, you'd never believe what happened to me last night. And I told her the story. So I said, did you realize that our family's history intertwined? What? She said, what? I'm from Ireland. Galen is from Canada. You're from Jamaica. How is it possible that we have historical connections? I said, well, Galen's eldest brother, his name is Granger Weston. He owns a hotel in Port Antonio, Jamaica, a very small village in Jamaica. And my mother was Granger Weston's bookkeeper. So that's how our family's history intertwined. So she laughed. So I said, okay, Mrs. Weston, so why are you here? She said, well, Mike, as you know, Toronto is in a funk. The ROM is trying to raise $200 million. And nobody wants to step up to the plate. So that's why we thought we should come to Burlington. I said, yes. So what does that mean? She said, well, we're looking for a lead donor. I said, yes. So I said, how much what does that mean in terms of dollars? She said, this was back in 2003, right? $30 million. So I said, what? $30 million, Mrs. Weston? Why didn't you this morning, instead of having to drive through the snow to come to Burlington, why didn't you roll over in your bed and say, Galen, just write the check? Right? She said to me, so I posed that question just to see how she would have reacted. She said, well, Mike, everybody knows Galen can write the check. So if Galen wrote the check, it would be a yawn. But if you wrote the check, it would be an inspiration to every single Canadian, to every single immigrant, as to what Canada holds for everybody. And everybody who walks through this path, crosses this threshold of the ROM, will be inspired. I thought, oh my gosh, I'm in checkmate. My only solace was she didn't ask for more. That's how I got roped into it.
We're glad you did. But in terms of other things, I know you're the chairman of the largest bank in Jamaica. Can you talk about why you took on that role, your journey, your success so far, And how has this expanded your philanthropic efforts in Jamaica?
Well, you know, when you are, if we all should try to be as conscious about our situation as possible, contextual. We should be, we should make sure situationally, we should be situationally aware. We should try to be as situationally aware as possible. Then we'll have a better context of ourselves in society and the world, if we're situationally aware. So in 2002, March of 2002, I found myself in the office of the finance minister for Jamaica. And my family was there. My mother, my father, my 8 siblings. And I was just about to write a check to buy the National Commercial Bank of Jamaica. It's like writing a check to buy the Royal Bank of Canada. So just before I wrote that check, I thought, oh my gosh, this is where the situational awareness comes in. Oh my gosh, what is happening here? How is it possible that this son, myself, of an orphan, she's sitting over there, my mother, could now be writing a check to buy the National Commercial Bank of Jamaica, which was formerly Barclays Bank of Great Britain and the Royal Bank of Canada amalgamated? How is this possible? That this lady was an orphan. She had me when she was 17. She was 18. She was a single parent. Her son is now buying the National Commercial Bank. How is that possible? When my father, my stepfather, in 2000, when I was 11, in 1962, applied for a job as a teller at the bank, and he was turned down because he was not, his hue, his complexion was too dark. How is it possible that his son is not going to buy the bank? I thought, wow. 3 answers came into mind. It's possible for 3 reasons that I had nothing to do with. Number 1, it's possible because I was born to a mother, a woman who had high standards, who led by example, who could have emigrated to England, which is what Jamaican women did, young Jamaican women did then, and left their children with grandmother. She could have emigrated, but she said no, she refused. She's going to stick with me and lead by example. I didn't choose my mother. I was blessed to have gotten that one. Secondly, the second answer that came to mind was I was born in a country that made me a confident human being. I could have been born in another country, not too far in America, as an example, or countries that bombs are being hailed on. And my confidence would have been immediately truncated. I didn't choose the country in which I was born. I was blessed to have been born in that one that made me a confident person. And thirdly, I was born in an era in which I could be educated. I could own a pen, a shirt, a pair of shoes. If I was born 250 years prior, I would have been owned. I didn't choose my era. Oh my gosh, I was blessed. So Mike, you have been inordinately blessed. Mother, country, era. What therefore and by the way, there are millions of kids who were born on the same day as you, January the 3rd, 1951, who was born to parents who who had no standards, no values, no commitment to family, who was born in countries that truncated their confidence, who were born in an era that made them, that they were perfect misfits for. You are fortunate. What responsibilities do you have therefore to all those people who are less blessed? Any? At that point, I made a commitment. I'm going to use this bank, this institution that I'm buying, as a vessel to build a better country. So I changed the mantra of the bank immediately to NCB, building a better Jamaica. And it's taking that approach why the bank started off with a market share of 24%. Scotiabank then had a market share of 54% in Jamaica. Today, NCB has a market share of 44% and Scotia 28%. It was that approach and the 10 characteristics of I went through with you of wealth creating businesses that I focused on, and changing the focus of the bank to one of building a better country. So when the staff members come in every day to work, they make a nexus connection between, why am I doing this dreary key punch operation task? I'm doing it because I'm making sure that I am connecting my work here today with making a better future for my children. So the bank is very philanthropic because of that attitude. And it's because of its philanthropy, the bank's philanthropy, which makes it unique in the country, which makes it unique as a corporation. And the citizens of Jamaica has recognized that, and they've risen to support the bank.
Thank you so much, Michael. And I'm going to turn it over to Matt to do the thank you.
Thank you, Michael, on behalf of our club. What a distinct pleasure and honor it has been to be in your presence for what has just gone by in the blink of an eye. And I'm inspired to talk to Akila. I want access too to the 15 principles that you outlined. And what I find from what you shared is it is very commonsensical. There's a practicality to it and a simplicity to it that I think many of us get caught up in wanting to have the complexity, as we think, you know, something innovative is something that no one else has seen, and that's the direction we need to go, when yours is so well founded. And I'm sure that you've created many wealthy people with this philosophy, and that is a gift that will ripple forward along with your vision for philanthropy, prosperity with care. I've made copious notes, and I want to thank you on behalf of the club, as I'm sure this has been one very memorable session together. So thank you for that.
You're most welcome. Happy to be here.